Welcome to the SOFI Weekly FX Market Updates. Market focus of the week will be the US midterm election. Currently, Democrats are controlling both the House and Senate marginally. Now all 435 House seats plus 34 Senate seats are for voting election. In polls, voters regularly say the recession or economic growth and inflation are their top concerns.
So the economy is up, price inflation is down.
Will Democrats win the midterm? History says it is unlikely. There are 13 midterm elections since 1970. Only 1998 and 2002 year was the ruling party managed to get more seats of Congress from mid-year election. All others years are ruling party losing seats to opponent. Biden Democrats is now 50-50 in Senate and is just 13 seats marginally more in the House. Any loss of seats in midterm will mean losing controls to either Senate or the House or both. If Republicans win either the House or Senate, we will see some kind of legislative gridlock. President Biden would be limited in his ability to push through any new policies over the next 2 years. If Republicans gain control of both the Senate and House, President Biden's government will face a strong headwind. Any policy initiatives from the Biden administration would likely be countered with objections. If Democrats retain both the Senate and House, a scenario that's considered the most unlikely outcome based on pre-election polling, it raises the potential passage of Democrats' more sweeping policy agenda. What will be the impacts of midterm results to the equity and FX markets? From historical data, it shows that no matter how many seats lost or even both Senate and House control are lost to the opposing party, the equity markets will move higher in almost all the cases 3 months, 6 months, or 12 months period after midterm. It doesn't matter whether the equity market is rising or falling in the preceding 12 months of midterm. In the table above, we can see only 2002 and 2014 see small decline after midterm in 3 months. But what is the myth behind? Markets simply don't want uncertainties. When ruling party lost controlling seats, less unexpected policies will be pushed forward and markets become more predictable. Midterm results seems to have less impact to the US dollar direction, as the US dollar should be more related to the Fed actions and interest rate directions. With prevailing sky-high inflation, Fed will keep its tightening policy and US dollar will continue be benefited. Fed raised the interest rate by 0.75% on the 2nd of November, bringing the Fed rates to 4%. Initially, market is happy to hear Fed say will consider the cumulative tightening impacts before determining how high to raise rate in coming months. But Fed President Jerome Powell afterward come out to say that terminal interest rate will be higher than previously expected, and it is far too early to pause interest rate hike. Now CME Fed futures is now pricing in a terminal rate at 5.5%, which appear in June 22 instead of previous 5.25% in May 22. The terminal rate is raised while the time of rate hike is extended. These will be positive to the US dollar. Interest rate expectation move up with peak now at 5.5% instead of 5%. Last week US dollar getting stronger as expected. US dollar as expected found support at 109.50 and climb high to 113 on Fed rate hike, and more hawkish Powell comment. But on Friday, US October non-farm payroll slowed down to 261K, better than expected 19.3K but keep dropping off. Unemployment rate also rose 0.2% to 3.7% while average hourly earnings fall from 5% in September to 4.7% in October. Some Fed members starts to come out to call for slowing down interest rate hike. The job figure and Fed members' comment pulled off the US dollar from high. After all, the correction down will be short-lived and limited by 109, and trading range between 109 to 113. Sterling pound dropped 2% the most amongst majors against the US dollar last week. Bank of England Governor Andrew Bailey rolled out its biggest interest rate increase in 3 decades last Thursday. Interest rate is raised by 0.75% to 3%. However, Bank of England depicted a gloomy outlook with inflation to reach 11%. UK economy will fall into recession in Q3, which may extend to mid of 2024. Unemployment rate may rise from current 3% to 6.4% by 2025. Last week, we shorted sterling pound at 1.160 with stop at 1.170. It is expected sterling will continue to be under pressure with target at 1.10. Australian dollar with less aggressive rate hike plan now become a bit lagging, but news circulating that China is going to relax its COVID control measures will be positive to Aussie. Australian dollar trading range will be 0.62 to 0.6550. Major focus this week will be the US Congress mid-election.
I will be back.